Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights, with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
Welcome back to ETF Market Insights. I'm your host, Erin Allen with BMO ETFs. And today we're going to hear from Jennifer Lee, BMO Sr Economist, on the trends to watch going forward and the economic outlook, as we continue to see a lot to talk about in the market environment today. But before we get started, a quick reminder that we're not providing any investment advice or recommendations. Our channel is all about providing education to DIY investors here in Canada. So today, as I mentioned, I'm joined by Jennifer Lee. She is the Managing Director and the Senior Economist with BMO Capital Markets. She's been there for more than 2 decades and is well known for her research and her colorful commentary. You can actually access her research. It's available publicly on capitalmarkets.bmo.com under the Research and Strategy tab. So welcome back to the channel, Jennifer. It's good to have you.
Thank you. Thanks for having me.
Let's kick it off by taking a look at the hottest topic lately, inflation. Can you walk us through the latest CPI print for Canada and the US and what it means for our economies?
Okay, sure. Great question. So hi, everyone. I think just stepping back, if we learned anything over the last 4 years or so since the pandemic, it's just to be careful how to define transitory. Do you remember that word? The fact that nothing or rarely does anything go in a straight line, and that 1 or 2 months do not make a trend. And that's basically what the learnings have been. So we've certainly come a long way since the days of surging goods prices, during the pandemic when we had all those supply chain issues, and don't need to repeat all that because we don't need to relive all those memories. But now we're looking at headline inflation, and all that has come down like everywhere around the world. We're looking at core inflation, and all those inflation measures have come down around the world. And goods prices are certainly down because demand is down. Has cooled a lot. We have fewer supply chain issues, but some of them have not gone away. Some of them are new. But now the issue is basically centered on services, and this is a global thing. We're seeing key services inflation in the US, we're seeing it in Canada, the UK, and Europe for sure. Now, just as an example, for Europe's June CPI report, we saw core and services inflation sort of continue to rise at the same pace as they were rising in the prior month. So they didn't slow down at all, which was a bit concerning. Some are pointing to the Taylor Swift effect because the Eras tour is now hitting all over Europe. But you've also got the Euro 2024 in Berlin right now. So all that has probably had some impact, some upward pressure on services CPI. Now, again, that might apply to Europe, but even broadly speaking, again, you're seeing it in other areas like travel. And I always talk about how, I think it was Royal Caribbean Cruise Lines a few months ago was talking about how they needed to hire thousands more people because there is so much demand from customers or clients trying to go on cruises this year. And Norwegian was another one. So anyway, now in terms of the latest prints, very interesting developments. Erin, as you're pointing out, we had Canadian CPI for May landed on the high side of expectations, and that was the first time that happened this year. Again, the headline with CPI was decent. It was at 2.9%. 4 of the key core measures were averaging about 2.6%. So everything's still sub 3%. Goods prices were steady at a 3-year low of 1%. Things like cars and furniture and new homes, those prices have come down. The services, sticky, 6-month high of 4.6%. This is like areas like housing and mortgage insurance and rent, cigarettes, dining out, things like that. Although cigarettes are not exactly goods or not exactly services, but you get the idea. Mostly on the services side. So, are we worried? The May increase was a bit unexpected, but it's only one report. One report does not make a trend, but it's definitely, I think, will cause the Bank of Canada to have a bit of a rethink on rate cuts. Now, again, it's only 1 month. It doesn't change the overall picture. So we're going to have to see what the June CPI brings later on this month. Now, for the US, kind of the opposite. In fact, we had January, February, March landing on the high side of expectations. April was decent. It actually met expectations, but the bar was pretty low. And then, of course, May landed on the low end of expectations, and there was much joy in Whoville when we saw that number. Even the Fed chair and every FOMC member did say that it was good news and it was encouraging, but we need more of those kinds of numbers. In terms of the details, the headline was good. It was like only flat. It was unchanged in the month. Most moderate reading in 22 months. Food was up modestly, energy was down. Core CPI was up only 0.2%, which was the most moderate reading in 33 months. New cars prices were down, clothing, recreational prices, airline fares. But it was like used cars, housing, and medical care. That's where it continues to see some upward pressure. So bottom line, are we going to get overly freaked out or excited about 1 or 1.5 reports? I say 1.5 for the US because April was kind of, again, the low bar. I'm going to say no for Canada. We're not going to get overly freaked out, but I will say I'm a bit relieved to see, some of these better numbers coming out of the US. Now, in terms of what it means for the economy, it means that the US is finally slowing down enough for inflation to start coming down, and that will make it much easier for the Bank of Canada to continue easing policy.
Very good update. That was a lot. Thanks, Jennifer. And then, let's get into the monetary policy around the globe and how the different countries are reacting as they look to tame this inflation. Can you give us an overview there?
Oh yeah. So hopefully this won't take too long either. But this is a period of time where I've been saying that we've never seen all these central banks almost moving in different directions. I mean, mostly everyone is focused on easing at some point, maybe not now, but in the future. But they're at different stages in their careers, I guess. So let's just start off with the Bank of Canada and the ECB. The Bank of Canada was the first in the G10 to finally cut rates. It was widely expected, at least it was for us. We had a June rate cut call penciled in for quite some time, and they're obviously confident and comfortable enough to lower rates 25 basis points. The ECB follows suit the following day with a 25 basis point rate cut as well. That was really well telegraphed. They basically told everyone and their grandmother that, hey, we are going to cut rates in June, and that's the way it's going to go. I would have been shocked if they did not. Now, going forward, the things are a little bit iffy, a little more iffy. We are not looking for a July rate cut from the Bank of Canada, just especially after this, a little hotter than expected May CPI report. But again, that's only one number. And if the June CPI comes in equally as soft or as cool as the May CPI was warm, if you know what I mean, then that could introduce a possible July rate cut. But in the meantime, for the Bank of Canada, we are only looking for 2 more rate cuts after this June move. We're looking for September and December. For the ECB, again, they cut as everybody expected, but July is, I think it's pretty much, there's no way that they're going to cut in July. September is when I've penciled in the next move, but everything, it's not going to be a unanimous vote for that. There's still quite a few governing council members who are quite concerned about still sticky inflation. And in fact, a couple of them have said that September's not even September's not a done deal, that we have to talk about it. But I think the broader majority, I think, of the ECB is going to vote for a rate cut in September. And then that's what we see things ending there for now. Everything's going to be data dependent. Bank of England they have not started cutting rates yet, but I think we're going to have to wait to see how this election pans out, even though it looks like most likely the pollsters are correct, and we're going to see the Labour Party take over number 10 Downing Street this coming after this election, and then we'll see what the Chancellor brings on, what kind of policies they introduce, and whether or not that's going to help or hinder the Bank of England's goal of bringing inflation back down to target. But so far we have seen improvement. Inflation is coming down, so we are looking for an August rate cut from the Bank of England. RBA is very interesting. They're on hold, by the way, but they're still fighting very persistent inflation measures. We've ultimately looked for them to stay on hold until probably December of this year. But the interesting twist to this is that they're still talking about rate hikes. Yes, you heard me right, rate hikes, because of this whole persistent inflation bit. But I think the bar is set pretty high for the RBA to actually start raising rates. So anyway, again, we look for them to stay on hold, maybe continue to talk hawkishly, but we look for the next move to be a cut in December. Bank of Japan is another funny one to look at, just because inflation has already peaked and is coming down, but you've got the yen at the lowest levels since 1986. So I think I wouldn't be surprised to see the Bank of Japan tighten policy just a little bit at their next meeting in July, because they already started tightening earlier this year, but rates were just at a very low 0.0% to 0.1% range. So that is still uber low. So I think it wouldn't be that harmful just to raise rates a little bit on that front. Finally, the Fed. Inching toward that rate cut, which we believe is going to happen in September. They are obviously, as of today, not yet comfortable and confident enough yet to start easing policy. They want to see more encouraging inflation reports. Haven't seen enough yet to convince them, but I think they're heading in that right direction. Again, we saw that encouraging May CPI report. I think if we see better reports out of June and July, and they will be released in July and August, that will hopefully pave the way for what we believe will be a September rate cut. It's going to be bumpy along the way, but I think if the broader picture pans out the way it is panning out already, I think they will be ready to cut rates in September. And by the way, we are looking for 2 rate cuts from the Federal Reserve, September and December.
All right, lots to watch there. We will wait with bated breath.
Me too.
Let's touch on China. There are rumors lately that they might consider leveraging their currency to reflate their economy that's facing all kinds of challenges. So can you touch on this and give us just an update overall on China's economy?
Sure thing. So China's, again, another interesting story. They started off the year on a strong note. I'm just going to talk about the economy broadly speaking first. January and February, we saw some pretty strong numbers that gave everyone, encouragement enough to, feel that they're going to meet that the growth target. Count me as one of the skeptics about meeting their about 5% growth target, just given that some of the data, or almost all of the data, since earlier this year has been more on the softer side, and you can blame the property sector struggles, still a big issue, and especially given that the property sector, like housing, makes up the bulk of the household's balance sheet. So if you're your household and you see your home losing a lot of value, not selling, it's going to hurt consumer confidence. It's going to hurt consumer spending. It's going to certainly hurt profits and inflation and limit the amount that businesses can raise prices by, and limit, again, profitability. Of course, there's also the trade issues, a lot more protectionist issues that we are seeing crop up, particularly against China, and of course coming from the U.S., from Europe, and from Canada, and a number of other countries. So I think Chinese economy is still struggling, and I think it's going to be a struggle again to meet that about 5% growth target. And so you're going to see them, drumming out all these different measures, like cutting rates, cutting required reserve ratios. So that's on the monetary policy front. You can see them stepping in more, using fiscal measures as well, again, to boost the economy. So that's why, with all this in mind, it's kind of tempting to consider devaluing the yuan. And yes, that rumor, as you pointed out, is definitely making the rounds these days. It's certainly not our base case scenario. I think a lot can go wrong if they cause the yen to purposely depreciate sharply by around 5%. 2 other senior economists in our group, Art Wu and Eric Johnson, they wrote about this actually very recently in our weekly focus report. And so they sort of likened it to giving the economy a Japanese yen-like boost to help stave off disinflationary or deflationary pressures, and that might help boost inflation. But we got to note that at the same time, inflation peaked last year, so it's already on its way down. So I think it's more for I don't know if the yen is actually weaker yen is going to help that much anymore. Again, given that inflation is on its way down. The yen, by the way, as I'm speaking now, it's about 161 right now, which is very weak. It's considering the fact that it started off the year at around 140, but 161 is the weakest since December 1986. And here I'm going to date myself here, but that is when the last time that happened is when Akina Nakamori was dominating the charts. So she was just this big Japanese pop singer. So that was a long time ago. But obviously deflating the yuan will have big downside risk. It's going to cause strong capital outflows. And yes, there are outflows, even though they have continuing tightening capital controls. And it could also cause a lot of financial instability, because no matter what controls they have, you always seem to see money escape the country. These people can still get the money out if if there's a will, there's a way. And that could, of course, weaken the bank's deposit base and limit credit growth. And of course, how's that going to make China look to the rest of the world if they actually devalue the yuan? It's going to be like, oh, the U.S. is going to say, oh, they are now currency manipulators. So they're going to put that label on China pretty fast, and then bring back more tariffs, or bring on the tariffs, or more of them. And of course, there's the impact, of course, on the rest of the currencies across the rest of the Asian Pacific region, because these other countries have to stay competitive too. So bottom line on the whole yuan devaluation front, tempting, but unlikely.
Interesting. Very interesting. Okay. And I know we are recording this on July 4th, Thursday, and this is going to go live tomorrow when a new job number is supposed to be coming out. But what's the latest on the labor front and unemployment?
So that's a big question. Broadly speaking, again, I'm going to say it's still tight, the labor market, more or less. And it's less so if you're looking at Canada. Our chief economist, Douglas Porter, he's described it recently as going from, as he described the Canadian job market recently as going from extraordinarily tight 2 years ago to leaning loose now. And you don't have to look too far than just looking at job vacancies, which are down a lot in the latest month. They're actually down 40% since the 2022 peak, when they had over 1 million job vacancies. So still vacancies out there, but they're coming down a lot. The vacancy rate, the job vacancy rate right now is at 3.2%, which is actually lower than they were in the months leading up to the pandemic. So that's how you can tell that it's more loose now, or the Canadian job market. The latest report, again, we were just looking at May. It was actually stronger than expected. Just looking at that one number, it was up 26,000, over 26,000 in the month. But the details were softer. It was all part-time. It was all centered on mainly Ontario. It wasn't broad-based. Goods sector was still shedding jobs. Services were still hiring, like healthcare and transportation and housing. The labor force was up over 54,000 as well. And I guess the more worrying part is that the jobless rate ticked higher again. It was up 0.1 percentage points to a 28-month high of 6.2%, which is again the highest since January 22. Third month in a row that was over 6%, and it's up over 1.5 percentage points from the lows in 2022. So you're seeing the jobless rate move higher. At the same time, wages are still climbing. They're up over 5% year over year. Is that worrying for the Bank of Canada? Probably, but they're probably going to note that there's still overall rising slack in the job market. So even though you're seeing that steady climb in the jobless rate, you're seeing a rise in the involuntary part-time rate to over 18%. So they're probably going to say that it's just a matter of time before wage growth starts to slow down. So it's just like a lagged effect. So overall, it's still consistent with growing slack in the overall economy. So again, something that the Bank of Canada is obviously going to keep a close eye on. Now we're looking at the U.S., very different animal. I would still classify the U.S. labor market as being still tight, not as tight as it once was, obviously, but still quite strong. The last report that we saw from May had very mixed signals, so there was a lot of debate amongst analysts about what was the right survey to look at. There's the establishment survey, and then there's the household survey. So that's why in situations like this, you have to look at, and I'm going to borrow the central bank wording at this point, you have to look at the totality of the data, because you have to look at all the different job measures out there and make sure that they're all telling this similar story. So in the last report for May, we saw the establishment survey completely beat expectations. Payrolls were up 272,000 in the month. It's actually still below what we saw in the first quarter. If you're looking at Q1 versus Q2, job growth has slowed, but it's still 272,000 is still pretty darn good. Household survey had a very different measure or a different message. It showed that household employment was down by over 400,000 in the month. Showed the labor force was down by like 250,000 in the month, and the unemployment rate also ticked higher, just like in Canada, by 0.1 percentage points to a new tightening cycle high, or a 28-month high of 4.0%. So that was kind of interesting to know, but 4% is still very, very low in my opinion. And it was interesting because this past week at the ECB forum in Sintra, Portugal, Fed Chair Powell still classified or characterized the labor market as being strong. And I think he's right. I think it still is. It's just less strong than it once was. And we're probably going to start seeing some softness creeping in just as the economy is slowing, and that would completely make sense. So that's a good thing, and this is what we want to see in order for the Fed to start easing restrictive policy. So my long-winded way of answering your question is still tight, but less so in Canada. In fact, you couldn't call it looser, but I think it's still fairly tight in the US.
Okay, good stuff. Let's change gears and talk a bit about housing. In a typical monetary policy driven housing market downturn, home sales fall on weaker demand, therefore causing home prices to drop. But this housing market downturn hasn't really followed that script. So what are we seeing in terms of home sales and prices in the housing market today?
So I find this, it's a very difficult situation to look at, to see and to read. We have seen prices, we have seen sales decline, and by default we have seen prices drop as well, but we're just not seeing that pickup in demand that one would have expected after, as home prices decline. And I think it all comes down to affordability. I think that's the key word to all of this, is just affordability. So even though we saw the Bank of Canada finally cut rates 25 basis points in June, that was only one cut. It's not going to change it's not going to change the housing market. It's not going to make a turnaround just like that. What it does have an impact on is, the psychology, I guess, and just a sense of relief that, rates have finally peaked. They're going to start coming down. We don't know when or how quickly they're going to start coming down, but they have finally peaked. And that, I think, is a good thing, again, from a psychological standpoint. But it's not going to make a meaningful impact. And I think it's about, we're estimating like you need about a series of rate cuts, probably like 100 basis points of rate cuts before you start seeing a meaningful turnaround in the housing market. And, we look at like 5-year mortgages, for example. You've got homeowners with 5-year mortgages, the ones that locked in like around maybe 4% 5 years ago. Mortgage rates have come down since the Bank of Canada has cut rates, but they're still well above that, that rate that they locked into back in 2019. So it's still not attractive enough, or again, doesn't make it affordable enough for these home buyers to step into the market right now. So our Robert Kavsik, by the way, who looks at this 24/7, he basically did the math, and he says he feels that you need mortgage rates to fall below 4%, or you have home prices take another 12% haircut, or you have to see your own income levels jump 12% to make it more attractive to get back into the housing market. So I think it's going to be up to mortgage rates to come down further and prices to come down further before you start seeing a meaningful impact. And this is probably why, again, all boils down to affordability, and it's just not as affordable just yet.
Okay. And let's talk a little bit about currency. What's the story in currency this year and your outlook around CAD versus US mostly?
Oh man, the currency market has been describing as the bane of my existence. Just making calls on the Canadian dollar has been very, very difficult. And I think, so overall, sort of how we've seen, or we describe the U.S. economy as being very resilient, and it still is, even though we have started to see that softening coming in. Just as the U.S. economy is resilient, so is the U.S. dollar, and this is because we have not seen yet a lot of signals. Actually, recently we have seen more signals, but up until recently, we haven't seen that many signals from the Federal Reserve showing that they are ready to start easing policy. And this is what has kept the U.S. dollar still quite strong and still quite resilient. But I think once you start getting a whiff of slower economic growth, and once you start getting a whiff of slower inflation, and once you start getting a whiff of a more comfortable and confident Federal Reserve, and we are starting to get to see that, that is going to prompt the U.S. dollar to start weakening. And by the flip side, you're going to start seeing some strength coming back for the majors, like of course the loonie and the euro and the pound, maybe possibly even the yen at some point. But again, it's going to have to come. It's going to all start with the Fed, and I would classify this more as a weaker U.S. dollar at some point versus a stronger Canadian dollar or a stronger euro. So we still have the currencies. We do have the currencies, the major currencies, strengthening by year end. Again, as we start seeing the Fed begin to cut rates, which again we believe to be happening in September, and that's when you're going to start seeing some weakening in the U.S. dollar. We'll see the U.S. dollar weaken even further next year, but we will see some. We should start seeing some of that softening taking place by the end of this year. So we see the Canadian dollar ending off this year at about 133-ish or so and change.
Okay, and let's cap it off by bringing it back to sort of the DIY investor's portfolio. Curious as to your thoughts around what you think the top risks are that investors should be considering when it comes to their investment portfolios.
It's that's another tough question. So there are a lot of risks out there, especially now. I'm going to point to political risk, political uncertainty. We've already seen some of that play out. I mean, this has been a crazy year for on the political front, with over half of the global population casting their vote, casting a ballot in some way, shape, or form around the world. And we're seeing some fallout of that, in Europe with France's elections. We're seeing the fallout from in the UK with their unexpectedly early election call. And of course, whatever happens in November is going to have a big impact. So there's a lot of policy uncertainty on that front. So that's what I think investors have to be wary of, is that there's going to be a lot more volatility to come because of that next election in the fall. There's also the risk of, just central banks and staying restricted, keeping monetary policy restricted for longer if inflation remains sticky. Again, this is not our base case scenario, but if you remember at the start of the year, there were a lot more rate cuts built in or expected from the Federal Reserve than what we're looking at now. So now we're looking at 2, maybe even 1 Fed rate cut. At the beginning of the year, there were a heck of a lot more. I think the number 7 was being batted about. Yeah. So things can change. So you got to be careful of that. And I think my third one to be careful about or to be watchful of is climate change. And this is more of a long-standing story, but I think climate change is certainly throwing off a lot of the growing and the planting season. So it's affecting commodity prices a lot. We heard stories about it, about orange juice prices soaring, cocoa prices soaring, but they've come down, by the way. Maple syrup, in Quebec, strategic maple syrup reserve running down at record lows, and most recently, I heard about olive oil prices surging as well. And, and that's having a big impact in Europe. So I think those 3 things, policy uncertainty, monetary policy uncertainty, political uncertainty, and climate change, I think are 3 of the things that I think investors should be broadly keeping an eye on, because it could have a big impact on potentially on your portfolio. But it's for sure will cause a lot more volatility in financial markets.
Okay, good ones. Thank you, Jennifer. Thanks again for joining me today. I appreciate you taking the time to share your knowledge. I hope to have you back again soon.
Thank you.
That's all for today. Next week, I'll be joined by Dan Kent from stocktrades.ca. We're going to be discussing what he sees as the biggest challenges for do-it-yourself investors in today's markets, and how asset allocation ETFs can look to solve some of these challenges for investors. So that's all for this week. We will see you next week. Bye for now.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.